A combined income of $120,000 with a mortgage sounds solid. Two incomes, one loan, plenty of buffer, right? For a lot of Australian couples in exactly that position right now, the answer is more complicated than that. Because after 3 rate rises in 2026, after tax, after the fixed costs of running a household, the actual gap between what's coming in and what's going out is often much thinner than the gross figure suggests. Today, we're running the real numbers for a real dual-income household, not the rule of thumb, the actual math. Let's start with what $120,000 actually becomes once the ATO has taken its share. Split it evenly, $60,000 each. On that salary, after income tax and the Medicare levy, each person takes home around $50,000 a year. Together, that's $100,000 in combined take-home, or roughly $8,300 a month landing in the account. That sounds comfortable. It's not an uncomfortable start, but we haven't touched the mortgage yet. Take a loan of $650,000, not unusual for a couple who bought in a major Australian city in the last 3 or 4 years. At current variable rates, which have moved up 3 times already this year, monthly repayments are sitting well above $4,000. Let's use $4,300 as a working figure. That's $4,300 out of $8,300. The mortgage alone is consuming more than half of combined take-home pay. Now add the fixed costs of running a household: utilities, groceries, petrol, insurance, phone plans, the basics. For most Australian couples, that's another $2,000 to $2,500 a month conservatively. Not lifestyle spending, just the floor-level cost of existing. Add it together. $4,300 for the mortgage, $2,500 for the basics. That's $6,800 against $8,300. Monthly surplus, roughly $1,500. That's the buffer. Not a savings account number, not what's in the offset, the actual amount of cash generated each month above what the household needs to function. $1,500 a month, under $20,000 a year. For a lot of couples, that number is smaller than they expected. Here's the truth most mortgage advice in this country won't say plainly. A buffer isn't just a savings figure, it's a cash flow question. You can have $30,000 sitting in an offset account and still be in a fragile position if your monthly surplus is thin. Because the moment one income pauses, that offset account stops growing and starts draining instead. And this is where the dual income structure creates a specific kind of risk that people rarely think about. 2 incomes feels like 2 safety nets. In practice, it's 2 points of failure on the same loan. If one person loses their job, takes parental leave, gets sick, or has their hours cut, you don't land on one income comfortably. You land on one income with a mortgage that was priced against 2. Run the numbers on that scenario. If the $60,000 earner stops working, combined take-home drops from $8,300 to $4,168 a month. The mortgage alone is $4,300. Before groceries, before utilities, before anything, the household is already underwater. This isn't a worst-case scenario. It's a fairly ordinary life event. Parental leave, a redundancy, a health issue, landing on a household that was structured around both incomes running simultaneously. Now, let's look at how the income split changes the picture, because not every dual-income couple earns evenly. An equal split, $60,000 and $60,000, gives both people moderate individual tax rates and a relatively balanced risk profile. If either income pauses, the remaining income is roughly equivalent. The household is stressed either way, but symmetrically. An uneven split, $80,000 and $40,000, looks different on paper, but lands in a similar place. Combined tax is slightly higher because the $80,000 salary pushes further into the 30% bracket. Combined take-home is actually marginally lower than the even split, around $99,000 rather than $100,000. And the risk profile is asymmetric. If the $40,000 income pauses, the household is under serious pressure. If the $80,000 income pauses, it's a crisis. Now at a third version, because it's the one that comes up most often and gets talked about least. A couple on the same 60-60 split, same mortgage, but with one child in long daycare 3 days a week. At $140 a day before subsidy, that's $430 a week in gross childcare costs. On a combined income of $120,000, the childcare subsidy covers roughly half. Out-of-pocket cost lands around $215 a week, or just under $940 a month. Run that against the earlier numbers. Monthly surplus was $1,500. Subtract $940 in net childcare costs. That leaves a monthly surplus of $560 on a $650,000 mortgage. $560 is not a buffer. It's the difference between a quiet month and an unexpected car repair, putting the household in the red. And this is still the scenario where both incomes are running, both people at work, no disruption, just the ordinary fixed costs of a household with one child in care, a mortgage, and a combined income most Australians would consider comfortable. Different household structures, similar squeeze, for different structural reasons. So what does a real buffer actually look like for this household, and how long does it realistically take to build one? The rule of thumb, 3 months of repayment saved, gives you $12,900. But run it against a real scenario, it's 3 months of mortgage payments with nothing left for groceries, utilities, or anything else that doesn't stop when one income does. A more honest buffer calculation for a dual-income couple on a $650,000 mortgage looks more like this. 3 months of total household costs, mortgage plus running expenses, at roughly $20,500, plus a realistic estimate of how long it takes to find new work in your specific industry, which for most roles is between 1 and 3 months. Combine those, and a genuinely resilient buffer for this household is closer to $30,000 to $40,000 in accessible savings or offset. Now, here's the part most people skip. How long does it actually take to get there from where most couples in this position currently sit? On a monthly surplus of $1,500, the no children scenario, saving $30,000 takes 20 months, nearly 2 years of directing every dollar of surplus toward the buffer before it's genuinely solid. That's assuming no rate rises, no major expenses, no months where the surplus gets eaten by something real. On a monthly surplus of $560, the one child in care scenario, saving $30,000 takes over 4 years. 4 years of consistent surplus saving with no disruptions to build a buffer that only covers 3 months of total household costs. That's not a failure of discipline. That's the arithmetic of this income bracket, at this mortgage size, at these rates, right now. Now, where that surplus actually goes matters almost as much as the number itself. And here's where a lot of couples are sitting on a risk they don't know they have. Many households in this position have been making extra repayments directly onto the mortgage, effectively putting their buffer inside the loan. That shows up as a redraw balance, not an offset balance. Those two things are not the same. An offset account is your money in a separate account. You can access it anytime, no questions asked. A redraw balance is money sitting inside the loan. Your lender controls the access conditions. Most Australian lenders reserve the right to restrict or remove redraw access, change the minimum redraw amount, or freeze access entirely during periods of financial hardship, which is exactly the moment you'd need it most. If your buffer is sitting in redraw and one income disappears, you may find the funds are harder to access than you assumed. That's not a theoretical risk. It has happened to Australian mortgage holders during previous economic stress events.
The practical implication is straightforward. If you're building a buffer on a thin monthly surplus, direct it into an offset account, not extra repayments. The interest saving is nearly identical. The access conditions are not. So here's the takeaway, and it's specific. First, calculate your actual monthly surplus, not what you think it is, but take home minus the mortgage, minus a real running costs figure. If it's under $2,000 a month, your buffer position is tighter than it probably feels. Second, run the one-income scenario. Pick the lower of your two incomes and ask how long you could sustain the mortgage on that alone. If the answer is less than 3 months, that's your real risk number. Third, check where your buffer actually lives. If it's in redraw rather than offset, understand what access conditions your lender applies. And fourth, if you've had 3 rate rises hit your repayment this year and haven't rerun your household budget since the last one, do it now. The number has moved, the budget probably hasn't. $120,000 is a genuinely solid household income. It's above the Australian average. But at current rates, on a typical mortgage, the gap between comfortable and one income disruption away from a problem is thinner than most couples realize. Now you have the actual number. If this helped, subscribe and share it with someone in a similar household who's been assuming the dual income means everything's covered.